Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, May 5th, 2017. So once again, stocks set fresh record highs. QQQ leads as Apple, Facebook, Google, and Microsoft hit new highs. We'll look at seasonality chart for S&P 500 and, do we sell in May and go away? Lots of strong readings in the stock market. Junk bonds pulled back from all-time highs. We'll look at that. Investment grade bonds did slide for the second week straight, but I wonder if there are still, still strength left in them. So the dollar also slid, and it's sort of at a critical juncture. And despite the drop in the dollar, gold had a really terrible week. And we'll look at that, and we'll look at GDX. Oil also dropped for the week and made fresh 2017 low. Lots of bearish indicators for XLE, and also it's really uncorrelated, so we'll look at that. And natural gas pretty much traded sideways for the week. Alright, let's look at S&P 500, ETF SPY. So all of the charts I use are going to be adjusted for dividends. And you can read and support here on MasterCharts.com. They adjust for dividends and splits. In other words, the effects of dividends are taken out of the equation. So with dividends adjusted, so total return, we did hit fresh all-time highs. We closed at fresh all-time highs for S&P 500. So once again, this is very good news for the stock market. Additionally, we had this really narrow trading range for the past few weeks, and looks like we're breaking to the upside here. So that's, I think, really good news. So again, last week I mentioned this quote here: when the market makes a historic high, it's telling you something. No matter how many people tell you why the market shouldn't be that high or why nothing has changed, the mere fact that the price is at a new high tells you something has changed. So this is an important piece of the puzzle. The advanced decline line is basically at fresh all-time highs, just a few points away, really. 3898, 3897. I mean, we're so close. So this is a strong chart, and I think obviously, in my opinion, the stock market is bullish. A little bit, we had weakened a little bit somewhat in the longer term readings. This is percentage of stocks above 200 and the bullish percent index. So even though we kind of pushed higher, we weakened somewhat a little bit for the past week. How much does it mean? Not sure if it means much, but I guess we will see soon. As far as the weekly chart goes, here's I pointed out last week this triangle-like consolidation, which is basically an inside wick, and now last week we broke out to above the consolidation, and this week we continued higher. So looks like we have two triangle consolidations and both resolved to the upside. So this is reaffirming the bullish posture, in my opinion. Now let's look at some seasonality figures. So seasonality of S&P 500, and the bars here mean percent of month in which S&P 500 closed higher than it opened. So in other words, in April, it's obviously a strong month, so 75% of the time the market closed higher than it opened, and the average gain was 2%. For May, 60% of the time market closed higher, but the average gain was only 0.3%. Now we get into the summer, and you can see that on average it's kind of like a toss-up. Around 50% of the time the market closes higher, 50% of the time the market closes lower than it opened. But you can see that over the summer the average gain is actually a loss, except for July. It's actually a loss here in July, but overall it the summer months are more difficult for stock market, so it does make some sense to at least account for the fact that we're going to have, most likely going to have, a more difficult period ahead. One way of dealing with this is to simply reduce your position size. So let's, for example, say that you usually risk $100 for each trade. Then, for example, during the summer month, you can cut it down to, let's say, $50 or $30. But again, I wanted to say that it doesn't always happen. So, for example, here last year in 2016, you can see that we had June, July, August, September, all positive months, except for October that was negative. So the fact that on average over the past 20 years this happened does not mean that we're going to have something like this going forward. So the leaders, of course, are currently technology sector, QQQ and XLK. So fresh all-time highs, fresh all-time closing highs here on Friday for QQQ. Advanced decline lines are confirming, and on balance volume is confirming as well the fresh highs. So this is all very good news. And I wanted to show a few stocks here. Facebook, all-time highs. Apple reported excellent earnings and moved to fresh all-time highs. Google also all-time highs, and Microsoft as well. You can see fresh all-time highs as well. So again, clearly a strong leadership from the technology sector, and technology accounts for like almost, I believe, 20% of the stock market, S&P 500. So this is definitely good news. IWM, the Russell 2000 small caps. So it looks like we have a breakout here last week to fresh highs, and now we just kind of pulled back. So this pullback for now looks normal to me, but it has been somewhat more choppy than the some other indices. Like QQQ has been steadily moving higher, while IWM kind of had a big surge here from November and then moved sideways more or less. But nevertheless, this is still a bullish chart. So I think we're, and you can see advanced decline line also confirmed the bullish posture. So we'll probably, most likely, will bottom out and continue higher. Industrials, very strong. Stock fund as well. These are all-time closing highs, 66.92 above previous highs. So very strong fund as well. Advanced decline line didn't yet get to all-time highs, but I think it's going to get there. Consumer discretionary, again, last week we hit fresh highs, but now we pulled back. So nothing terrible to worry about, actually. This is clear uptrend in my opinion, and this, the technology, the industrials, the consumer discretionary, they are all strong sectors, and more importantly, they are offensive sectors. In other words, they it's a good sign that they're leading during the bull market. Healthcare also very strong, despite some negativity that's coming from the Congress. Healthcare is moving higher, and these are fresh highs in advanced decline line. So this is a bullish divergence here. We haven't yet gotten to the all-time highs for the index itself, but we're already getting all-time highs on the advanced decline line. So again, this is looking pretty good and rather bullish as well. Consumer staples was the first ones of the major sectors to make highs, except for XLK, and then we pulled back. But I don't see anything to worry about. I think it's already trying to bottom out here. So again, I think it'll move higher. Here's real estate. Real estate is now a sector. It's no longer an industry group. So this looks like a hammer to me, a hammer candlestick with a follow through, and very nice looking. So I got hammer, gap, and a big white candlestick. So this is looking quite bullish, and actually we could move higher from here. Utilities also within a striking distance to fresh all-time highs, and you know, I know that people say that they're a little bit more interest rate sensitive, but that does not mean that they're bonds. They are still stocks. Now here we're getting into a little bit of weakness, and this is XLF financials. So financials had a big run here from November into March, fresh all-time highs here, oh, multi-year highs rather, and then pulled back. And now we're kind of having trouble here, I see. So like we're retesting 2017 lows here already on 2 occasions. We did gap up here and moved higher, but I have a feeling we're not yet done correcting here. So still a little bit of a bearish divergence here, haven't worked it off yet. The reason why I think we're not yet done correcting is because well, this is a weekly chart, so each stick is a week's worth of activity, and so here are the March-April lows here that I just showed, and you can see that the candles are not that strong. So even though this is a hollow candle, for example, here in March, there was still a upper shadow here out of the top, and it was significantly longer than the lower shadow, which implied that there was selling by the end of the week. Red candlesticks obviously are not bullish, and then you can see that the last 3 candlesticks for the last 3 weeks were not that strong, even though we have a gap here. So overall, I have a feeling that we'll still retest the April lows here, and maybe we'll finally bottom out and then move higher. And what I mean by bullish candlestick, I mean something like this, where you can see a strong presence of strong buying, something like that. But I just don't see it, you know, basically since February. Finally, junk bonds. Here what I wanted to show on Thursday, we had a relatively big red candlestick, and this is on a day when stocks moved actually somewhat higher. So here the junk bonds actually moved lower, while stocks on this day on Thursday moved somewhat higher. So maybe junk bonds are signaling that maybe we'll need a little bit of a pause before this rally continues. It's possible. Weekly, you know, junk bonds at all-time highs. Again, this is an adjusted chart, so dividends are the effects of dividends is removed from this chart. So overall, I think stocks are bullish. I think we should expect fresh highs. Since we already are hitting fresh highs, I think we'll expect more in the near term. Okay, let's move on to bonds. Here's TLT on the daily time frame, also adjusted chart. So here in mid-April, I think we had a breakout above previous resistance highs, so we're 2017 highs. And now we're basically pulling back to the breakout levels. Now, this action is not terribly great, especially because of this gap here on Thursday, but it's not terribly ugly either. So looks like so far I'm seeing a breakout and a normal pullback. So if we consolidate here and hold support maybe around 50-day moving average, and at least continue sideways to possibly up, then I think we still have at the very least a short-term uptrend. Longer term on TLT, it's more difficult to say where we're going, because these are all-time highs, but these are 52-week lows, so it is a little bit more difficult to see the picture here. But it looks like we are seeing resistance which has been reaffirmed at the previous lows here from February and March of May 2016. So it looks like we are at the broken support level from November, and for now it is acting as resistance. Whether or not we will break above it remains to be seen. More diversified, this is a weekly chart, AGG, Aggregate Bond Fund. You can see it's stronger than TLT, whereas TLT barely kind of got up to the broken support here. AGG is well, I guess you can say that this is a broken support here for AGG. Just depends on where you draw the lines. But these are all-time highs for AGG here in 2016 June. So we are actually not that far off from all-time highs, and this is looking more bullish than TLT. AGG is more diversified. So for now, I see this chart as a bullish because we had a breakout to fresh highs in 2016, all-time highs, and now we're seeing a normal pullback to the breakout level. And for now, this looks like a successful retest of the breakout. So again, we will see where this goes, but for now, I'm seeing that there is some resistance, and it is it is coming in here. The resistance is coming in, but whether or not we will unravel and can collapse from here is an entirely different story. Here is finally LQD, which is a corporate investment grade bonds. Pretty similar picture to AGG. You can say that this is resistance from previous trading activity. You can always draw good resistance lines where the previous trading activity occurred. In fact, I can put on volume by price and show you what I mean. And you can see that there was more activity here than here before. So we are, in a higher volume area where trading occurred. Therefore, it makes more sense for resistance to come in this area. But again, I think this is so far a bullish chart for LQD. So we had a breakout in 2016, fresh highs, and now a normal pullback to the breakout level. So for now, I don't see a terribly bearish chart. It's not terribly bullish, but then again, these are bonds. So overall, I think if TLT decides to head lower, the rest of the bonds most likely will follow. However, if we break 2017 lows, that will be quite bearish for the bonds, I think. Alright, let's move on to Forex. Here is US dollar on a daily time frame. I mean, it's not very bullish right now because you could see that we are making a series of lower lows and lower highs. So lower highs and now actually another lower low. So we closed at 98.53, which is below March lows. In fact, this is a low for 2017. The door is now open to retest November lows. But the opposite is also possible. It's possible that buyers will come in here and move the prices higher, because we are at support, and support is pretty clear. I think it's around 99, 98 or so. So it's very possible that the buyers will come in here. They haven't yet. In fact, here on Thursday, it was quite a bearish candle with a follow through on Friday. So it's kind of difficult to say actually where this will go, because it could go literally either way. I think longer term, this is US dollar in the weekly time frame. I think still this is a bullish chart. This is a weekly chart. So we had a breakout in 2014 here. Very long consolidation that kind of looks like a double bottom. Now, if we take just this part here from 2016 into 2017, this could be like a cup and handle that I drew here. And so we're basically drawing out this handle. Also, this could be like a fallen flag or fallen pennant. you know, and if you like this kind of thing, patterns, you know, chart patterns, I'm not a big fan of them because they're more difficult in my opinion to trade. But if this is indeed a fallen flag, then this is a bullish continuation pattern, and we could break out, well, let's say above maybe 101, but better above March highs, and then continue higher. The opposite is also true, and we could retest November lows. Here are the November lows. I wouldn't necessarily be super panicked if we retest November lows. If I was a dollar bull, I am a dollar bull, but you know, if we retest, let's say, last August lows, then I would be kind of really questioning the entire uptrend. But we haven't done it yet, and so we're still a ways off. I think this is a bullish chart still, and I think the bullish resolution is more likely. Here is Euro on a daily time frame. Now, last week, if you listen to my videos, I was saying that I would be already pretty comfortable shorting up here, but honestly, I don't see a good. I like to short, you know, especially on daily charts when there is sufficient buying pressure. What do I mean by sufficient buying pressure? Something like this. This is sufficient buying pressure. Sufficient buying pressure. Big rejection candle. That's sufficient buying pressure. So I would be more comfortable shorting here, here, here. But here I just don't see it yet. I just don't see enough selling to justify going short here. And here is the euro versus US dollar in the weekly time frame. Still, I think very much a bearish chart. There's a multi-year lows here just in 2017, beginning 2017. So this looks like a normal rebound to me. It is definitely already overextended to the upside, and I would be, if I was trading this, I would be shorting it. When we see something like a shooting star or maybe a bearish engulfing with a follow-through. But so far I don't see it. Like here's a bearish engulfing, you can clearly see it. So far we haven't gotten it, obviously, so let's, you know, I would still be waiting and seeing where this will go. The British pound is weaker, and you can see already that we're seeing a red candlestick in a harami kind of position. So already I'm seeing a little bit more selling. This is very bearish, British pound. So it looks like a normal rebound that should be shorted, in my opinion. Where the resistance will reaffirm itself. Looks like we broke above previous resistance highs from November, December. But I think the very strong resistance would be up here in around 1.344 or even 1.38. Lots of resistance up here. Interestingly enough, the dollar is gaining versus the versus Japanese yen. So in other words, the yen is under pressure. Notice the past 3 weeks, so we had like a hammer-like candlestick, a gap, and a follow-through, and then another follow-through this week. So it looks like, you know, pretty decent-looking candlesticks on the weekly time frame. And in my opinion, this is a bullish security because we bottomed out here in 2016 and we rallied. And now we're basically correcting in a normal corrective pattern. And if you listen to my videos from November, December, I was saying exactly that we are going to see some resistance. Because why? Because we had trading here before. And this is a broken support right here from 2016 February. January, February. So we saw resistance come in exactly there. So right now looks like we're correcting. Maybe we're already done with the correction, and then maybe we'll see a breakout. Ideally, we should see a breakout above maybe like 115, and then we could easily push higher. So overall, it's right now kind of difficult to say where dollar will go, and the dollar is important because we're going to see. We're going to look at gold next. Okay, let's move on to gold. So gold, this is daily time frame, continuous contract. So a couple of weeks ago I pointed out this triangle consolidation where we had two inside days in a row with a bearish resolution, and notice that this was quite a strong setup if you like this kind of thing again, if you like chart patterns. So we had triangle consolidation, breakdown, and then shorts came in and took advantage of that. The weird thing is because it came in at the time when the dollar was also under pressure. So you can see right now we have a somewhat positive correlation between the dollar and gold. Usually it's strongly negative, but right now it's somewhat positive. So it is an unusual time. Where is this going? Not a great sign for gold, because usually when the dollar is dropping, gold should be taking advantage of it, and it's not. So here's GLD on a daily time frame, and I thought we had a breakout here to 2017 highs, but looks like this breakout kind of failed right now. So again, we're moving lower with a gap. We are sort of, we're definitely oversold after this move down in April and beginning of May. But I'm yet to see buying pressure, like something like this, big candlesticks, gap up. Right now, I just don't see it. I see the opposite. I see gap down. This could be an exhaustion gap after this big move down, but again, in order for me to go long, I need to see buying pressure, and I just don't see it yet. Here's gold on a weekly time frame. Look at this big red candlestick. This is definitely not what the bulls want to see. Last week I said that I would be somewhat comfortable shorting it already up here. Definitely would be comfortable shorting it now if you're a gold bear. Where is this gonna go? I think it will depend on the dollar. The dollar could go either way, like I just said, and if the dollar decides to rally, I think gold will come under further pressure. Let's look at GDX. This is GDX on a daily time frame. So first of all, GDX made a lower low relative to March lows here, and this is also a lower lowest level for 2017 and a lower close for 2017. So that's not a good sign. The good sign on this chart is that we have a little bit of a bullish divergence between the index GDX and advanced decline lines. So you can see advanced decline line made a slightly higher low. Advanced decline volume line also made a slightly higher low, and the bullish percent index also made a slightly higher low here. So there is a little bit of a bullish divergence. Whether or not it will play out, again, remains to be seen. The problem here, these are 52-week lows in December, and if we are already kind of breaking the March lows, so next target we could easily retest December lows, and that would be 52-week lows. And I generally don't like to be buying at 52-week lows. Notice that new lows, new 52-week lows are expanding. This week there was more of them. There was 7.5% lows. So this is new highs, less new lows. And I don't think there's any new highs in the GDX right now. All right, let's look at some of my proprietary indices. So gold breadth index overall improved somewhat a couple of weeks ago, and it was now at 3. The more short-term indicators, the percentage of stocks on the buy signal, also improved somewhat after bottoming at 0. And another indicator, which is a percentage of stocks on an uptrend, again dropped to 37, but now back up to 50. So we have a little bit of a bullish divergence here. Basically, you can see the indicators for the market breadth are improving, while the market GDX itself made a lower low. So this is a little bit of a bullish divergence. Additionally, we're now definitely oversold. That's another of my indicators, intermediate term Brett's momentum oscillator, proprietary indicator. We're now negative for it, so basically a buying opportunity. But again, I don't see presence of buying yet. I thought that this was going to work out on Friday, but this candle is just not that great. There was quite a bit of selling that came in at the end of the day. So overall, it's still a very mixed picture and difficult to see if we're going to bottom here or maybe we'll drop further. And again, we're going to be toying with the 52-week lows, and kind of makes things very difficult to buy at 52-week lows. Okay, let's move on to oil. This is West Texas Intermediate, light crude oil on daily time frame. So if you listen to my videos, I pointed out this resistance level in April. We came in exactly at resistance, completely unraveled, just dropped like a rock. This is now 2017 lows. Took out some of the lows here from November of last year, but looks like we rallied, and notice that we rallied at support to pivot point, and sometimes pivot points are useful because it kind of gives you an idea of where others will be buying or selling. And here at support 2 looks like the buyers came in relatively strongly, actually, because we had a big red candlestick at the beginning of the day, but then by the end of the day we formed what could be said a hammer candlestick. So this could be a hammer candlestick, and maybe we'll finally maybe we'll bottom here and I'll attempt to move higher. But now we have another broken support here at $47 exactly, and this broken support happened on Thursday. So resistance will be most likely come in here at around 47. Generally speaking, oil, in my opinion, is bearish, and this is because of this chart. This is a weekly chart, pretty clear downtrend. Even though these are 52-week highs, I think this is more, I would almost call it accidental 52-week highs. The reason because it was such a long consolidation and a rebound, but this is still a rebound, and I still think that the bigger trend is down. So we have a long consolidation here in December through March, and now we're finally breaking down, bounce, and another breakdown. So this could be the beginning of a move down, and I think we could see easily a retest of at least 42, possibly $39 area. You know, if you listen to the news here, you'll hear that American producers are ramping up production, and OPEC members are having a lot of trouble cutting production. So this is a basic supply-demand kind of issue. If you have a lot of supply, your prices will go down. I read an opinion today that oil also is not as relevant because of the improvements in basically fuel efficiency is one thing, but also a switch to more other sources of energy such as natural gas, of course solar and wind. So oil honestly is not as important. It is still important, but it is not as important as it was, let's say, even 5 or 10 years ago, before the fracking boom occurred. Okay, here's XLE, and this XLE chart is graphed together on the same chart with WTIC, and this is actually from last week, from April 28th. And here I pointed out this bearish divergence, so we have a lower low in XLE while we have a higher low in West Texas Intermediate. So let's fast forward to what happened this week. You can see now we have another lower low in XLE, but oil broke down below March lows. So this was clearly a bearish divergence, and this was sometimes the stocks that correlate to the security itself, that like for example GDX and gold, sometimes gold miners will lead the price of gold, and in this case XLE is leading the price of oil. Notice the same thing happened here in 2015. Notice this big slide while oil traded sideways. Finally oil succumbed to selling. Same thing here. Oil was trading sideways, but energy was already sliding. So looks like energy is moving lower, and it's leading oil there as well. Here's the energy on the daily time frame, and here I wanted to point out that, I know I pointed this out in the past, but I like to point this out a couple more times. Sometimes people forget. These are 52-week highs, but we had no confirmation from advanced decline lines, and these were not 52-week highs. In fact, when we turned around and started moving lower, we started making 52-week lows and multi-year lows on the advanced decline lines. So now we have fresh 52-week lows and fresh multi-year lows on the advanced decline lines. Notice the bullish percent index also is in very low reading. Also, just to be a contrarian, this is a little bit oversold, so we could see at the very least a bounce higher. And notice that on Friday here we had a pretty strong candlestick together with oil printing a possible reversal hammer candlestick. And finally here I wanted to point out this is S&P 500, and on the same graph I put real estate, energy, consumer staples, and utilities. And these four are the most uncorrelated sectors to the general market. So if I was to graph here financials or cyclicals, the correlation coefficients would actually be higher. So these four are the most uncorrelated to the general market. And notice that in general, even though they're quote-unquote the most uncorrelated, they're still very highly correlated. You can see that they spend most of their time in the positive territory. In other words, when, let's say, real estate moves up, the utilities and other stocks, S&P 500, will also move up, and vice versa. But notice here what was interesting is happening as of late, and this is very unprecedented actually. So you can see XLE, and this is chart going back 18 years. So energy, it has been extremely uncorrelated to the general market. This has never happened before. So this could be like another point that I was trying to make, is energy in its present form, XLE, where the oil dominates the energy sector, may be becoming less relevant to the general market. It's only like 6 or 7 or 8% of the general market, so its effects on the market as a whole are muted to begin with. But additionally, the correlations are kind of breaking down, and again, I wonder if this is something of a beginning of a new trend where the correlation of energy to the general market is not as high, or is this a simple outlier and eventually we'll move back into normal correlation, which is positive in this case. So I guess we'll see within the next few months to years. Finally, natural gas. This is natural gas on a daily time frame. I want again to point out that this is a very volatile security, and if you're a beginner trader, I would highly discourage you from trading it. There are other much better and easier securities to trade. For example, utilities. They're super easy. They're much easier. They're not as volatile, and they're just easier to trade. Anyways, here pretty much nothing has happened this week. We had a big surge last week and we more or less traded sideways, but it looks like we are moving higher again. I think this is a bullish security. I think we will see a fresh, maybe breakout above 2000, maybe above April highs at the very least. because these are 52-week highs. So we're, looks like we're moving higher. On the weekly time frame, if we do fail here and we move lower, then this could be like a head and shoulder. So this is the left shoulder, the head, and this is the right shoulder. And if we fail here, we haven't failed here yet. If we fail here and move down to $2.50 or so, and then we break down, then that could be like a head and shoulders kind of business. But it hasn't happened yet. Alright, that's it for this week's recap. If you like this video, please hit the like button below. If you have any comments, please do comment below as well. And of course, share this video with others who may benefit from watching it. Again, thanks for watching, and please stay tuned on how to find us on the internet. Thanks a lot. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now. So please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the success in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right, thanks for watching, and please consider signing up for the trade alert services. Bye-bye.